Know the difference between these three ideas: book value, liquidation value, and I'm not really worried about comparing multiples, but understand market value. Okay, book value is how much money the firm is worth on its balance sheet. That is different from having to liquidate all the assets such that you can pay some liquidation value. Usually, liquidation value is smaller than book value. And that is going to be different than market value, which is the price of each share times, let me do it this way, times the number of shares outstanding. So keep that in mind, those three differences. I don't know what's left here. Okay, so now we can talk a little bit about how an investment actually gets into place. You guys have heard about IPOs in the market. IPO stands for initial public offer. Off, initial public offers basically create stocks, and they are sold in primary markets. Market capitalization is the market price idea or the market value. It is the number of shares outstanding multiplied by the current price of the share. It's what we went over in the last slide. And treasury stock. So let's say a company goes out in the primary market and issues an IPO. And this IPO has 10 million shares. A company can then take 2 million shares and hoard it. And they can put it into their treasury. Put it into their treasury. They keep it. This is the treasury stock. This is stock that is not freely circulating, which means I have 8 million shares that, 8 million shares that is freely circulating. If I have 16 million in earnings that I'm going to pay out, I'm going to take $16 million in earnings and I'm going to divide it by the total number of shares outstanding. That's 8 million shares, and that's how I calculate a dividend. That's equal to the dividend. Okay. Know the difference between treasury stock and shares outstanding. We're really going to we're not going to cover all of this. Negotiated offer, key into the initial. We're not going to get into the details on the IPO. Know that they exist and that they're out there. Secondary markets. What's important here to note is that there are basically two markets. Here there's three that are listed, but it's perfectly fine. We're going to focus on primary and secondary markets. Primary markets are IPOs. They are most public investors, or most of us public investors don't really have much access to IPOs in primary markets. But secondary markets do exist. They are entities like the New York Stock Exchange or the NASDAQ. Okay? And as an aside from this, know the difference between stock markets versus indexes. Stock markets are where stocks get traded. Indexes are some mathematical measure of the value of stocks in the market. Okay, make sure you know the difference between stock markets and indexes. It's going to come up. Let's skip all this. And that appears to be the end of our presentation. I know I went through this a little quickly, but Chapter 5 is relatively easy. The things you need to focus on here are how to value a stock using the let me see if I can find a better place to draw. There you go. Let me see. So what you really need to focus on here is the price of the stock. Basically is going to be D over R, and then if you have a growth function, you're going to use D over R minus G. and then kind of know the way that stock markets work, know what an IPO is. And let's go over that really quickly, just so that everybody's on the same page. So here you are, and here is your investment firm, something like Bank of America or TD Ameritrade or whatever. And then this order goes out to the New York Stock Exchange. On the other side of the order, you have somebody else that has an investment firm or a stock market firm where you have an account, and they're over here interested in selling. So you put in an order to sell the stock with TD Ameritrade. The other person puts in an order to buy stock with their guy. And then both of these orders go over to the NYSE. And then it's the job of the New York Stock Exchange then to match up buy and sell orders. And in here somewhere, we get a good sale. So as this happens, keep in mind certain terminologies about stocks like bid, bid prices or ask prices, sale at market value, or well, let's not get into great detail in there. Just understand that there exists a series of firms, right? This is your firm, this is his firm, and the New York Stock Exchange exists to facilitate trade between these firms. Understand some of the infrastructure on how that works, and I think you should be pretty fine. This is a very fun but relatively short chapter.